Friday macro. You do it. You got this.
Okay, welcome back to the Friday Macro Show. Now we actually have a title for the Macro Show, not a restring being live. So, yeah, welcome back. We have quite a bit on the slate. Pretty crazy in terms of macro. We'll talk a little bit about CPI coming out in Canada. We'll talk also about Bridgemark, new capital allocation, essentially cutting its dividend by 96%. For those not familiar, they own the real estate brokerage Royal LePage. We'll talk about Google. Drops 7% on earnings that look quite good on the surface. So we'll touch a little bit on that. But
that's just the free cash flow thing in your view. Yeah, like it feels like pretty well priced, man. Like,
I'll kind of give. I have some reservations at what's happening with Google. I mean, you can make a case both ways. You can make a case that it's well priced. You can make a case that there's a lot of risks that are not being priced in by the market right now. We'll talk a little bit about that. Of course, Dan Kent and I on our Thursday episode will be diving a bit more into that. We'll talk about the new U.S. tariffs, an additional 50% on about $20 billion worth of Canadian goods. We'll talk a little bit, if we have time, Canadian retail sales. Not sure if you had the chance to look at that, Dan.
No, I didn't actually. I meant to, and because it's in my calendar, my open claw puts it in my calendar, but I didn't. I should have just got it to give me a summary.
That's okay. Yeah. So if we have time, there's so much to talk about. Obviously, resuming tensions in the Middle East, what that means for oil. We'll talk also about what that means for bond yields that have been rising pretty significantly. And I guess if we have time, along with the retail sales, maybe talk a little bit about the Japanese yen hitting something like 40-year low, something like that. So just being hammered. So a lot to talk about. I think we'll also talk a little bit about boomers not being able to sell their homes. So we were just talking about that as we started recording. I know you've been posting quite a bit about it, so I think it'll be a fun topic to talk about.
Yeah. Cool. Where do you want to start?
It's do you want to talk about June CPI?
Sure, yeah. Yeah.
Okay, what's your first impressions on it?
Well, I think and I didn't look at the retail sales, so I don't have a ton to compare to on the consumer, but our original read was this, the acceleration, like gas prices have gone up significantly, even though oil is being controlled and low from an input perspective by the strategic petroleum reserves, which I think we want to discuss a little bit. So consumers, it feels like, are, we saw gas prices come down in that period of time. But I feel like consumers are, there's potential that they're reacting in such a way that was sort of like what we forecasted, that, you're more likely to see a demand destruction outcome than a inflationary outcome. So I think, I don't think the inflation story is over. I'm going to try and I missed the button on your screen share there, but I'll figure it out. I don't know if you want to try and share it again, actually. Let me see if I can find it.
Sure. Yeah.
I mean, your consumers seem to be reacting in such a way that, like, there's probably limited upside to, significant long-term upside to the inflation story in the long term. I think that, gas prices could probably give us another couple of high monthly readings on inflation, but it seems to me like both the US and Canadian consumer are sort of reacting by spending shrinking on the inflation side. So I do still think that, conflict in the Middle East, oil price shock is more likely a recessionary or demand destruction outcome than an inflationary outcome. Personally, I don't think the consumer, especially in Canada, but even in the US, can absorb the energy shock.
Well, I think the data supports exactly what you're saying, and I'll show it with the retail sales because I know you haven't had the chance to look at it, but it definitely supports what you're saying here. So just wanted to show here. So in terms of year over year, gasoline was up 20%. But if we're looking for May to June, so essentially that's a period where the ceasefire started taking place, oil prices started trending down, of course, feeding into gasoline prices as well. So you had a 10% decline on a month over month basis. And I think the headline number came in at 2.8, which economists were saying expectations were around 2.9%. So definitely a bit softer than expected. But if you start looking here, for retail, you actually start seeing something a little bit interesting. So, in terms of gas, and this is May, so it's not like, the same month, but I think it still supports what you're saying. So, you're seeing in May that retail sales for gasoline station and fuel vendors were up. Oh, I'm not sharing the right tab here. There you go. So they were up 3.1%, but in volume terms, it fell 2.7%. And May saw a big price increase in terms of gasoline prices. And I think this is exactly what you were saying. I don't think there's a better data point than this right here. Is you're actually, retail sales as a whole on a nominal basis were up 3.1%, but in volume terms, they were down. So clearly there's some kind of demand destruction happening. And obviously, again, May versus June, but I think it tracks to what you're saying.
Yeah. Yeah. So I guess the question becomes like, bond yields are ripping again, pricing in that, we've talked a bunch of times about how the Fed will probably need to hike, or the market, that's what the market's trying to say. I just don't see it, but the market keeps trying to price that in. And the question sort of becomes from my lens is like, when does that end, and when does the market get realistic that, we're not in an economy that can support, rate hikes. I mean, or just the market's, the bond market's wrong and Fed fund futures are wrong, which, I think, again, it's a coin toss. Right? Yeah.
Yeah, I mean, the 2-year is considered a really good indication as where Fed's fund rates are going. And if people don't believe us, you can just go back 5 years and the rate hiking cycle. So you're looking right here, just showing here what it looked like in 2022. So July, you saw the open for July was like 2.9% for the 2-year, and then ended at 3.5%. And then in September, just like a month and a half later, that's when the Fed's fund rate actually was starting to hit that level too. So it was a very good indicator, and it's usually seen as a good indicator as to where the Fed's funds rate is going. But I agree with you. It's just, and even going back to the first press conference of Kevin Warsh, he did mention during that press conference that it really depends on what area of the economy you're looking at. And he pointed, I've said it before, but he pointed to real estate, that it seemed pretty restrictive right now at the current rates for their US real estate market. Whereas other areas, I think he pointed to like AI, for example, all the spending around that, you can make a case that it's not restrictive enough, and broad swaths of the economy, you can make a case that it's not restrictive enough. So I still think they'll do a wait and see approach. And I still think that rate hikes are pretty unlikely. But look, could be wrong on that, but that's my take on it.
Yeah. I think we are still aligned on this. Nothing's really changed my view. If anything, the data points that we're getting just cements my view that recessionary outcome is the most likely, or, at least a demand destruction outcome, and that the bond market and Fed fund futures just are becoming more and more wrong by trying to price it in the opposite direction.
Yeah. And so what kind of, just transitioning that to the Canadian housing market. So how do you see, what kind of impact do you see? Because clearly I'm sharing this over the last 6 months, but if you take the last month here, the 5-year bond yields for Canada have risen, 20 something basis points. So from around 3 to 3.2 right now, 3.22. And most obviously, a lot of that is very correlated with what we've seen in the Middle East in the past month too.
Yeah. I mean, your bond yields are up. They've been ripping for the last week and a bit, basically since we spoke last. I mean, they were up last time we spoke. They haven't so your 5-year bond yield sort of dictates what your 5-year fixed mortgage rate should be based on, the substitution effect that banks could otherwise, they can lend money to, Simon to buy a house, and they charge them maybe 200 basis point spread, or they can lend money to the Canadian government and, whatever. From what I can see, banks aren't eager to price this in. So that tells me that either they're they don't see significant willingness to pay or like price elasticity on consumers who they're already having a really hard time um, originating new loans. Like, most of their
Mhm.
business right now comes from the existing renewals or, so we're not seeing a ton of acquisition loans. So they probably say, okay, well, we're going to constrict um, mortgage demand even more if we start pricing it in. So their spreads, their risk premium are shrinking basically, which I think is interesting because I don't think the risk is increase is is decreasing. And usually you would see a risk premium decrease or shrink if risk was decreasing. I mean, they're up a little bit, but they're not up relative to like how they should trade relative. And
Yeah.
maybe we're just early. Like usually it does hit with a one week lag, give or take. But I don't know what your thoughts are there on that. But I like, and the other thing that's interesting is, I mean, we've seen a pretty clear variable rate preference from consumers on the most recent reading from CMHC. I'll pull up the CMHC residential mortgage industry report, but basically, the last reading, which was a while ago, and rates haven't changed much since then, and for a period of time, your variable rates were becoming more compelling on a price perspective. But if you look at it here, sorry, I'm trying to get the zoom and scroll thing going here. I don't know if that works. Yeah, sweet. Um, your basically your variable rate. It's kind of hard to see, but because it's like a very pink line, but 45% of total new mortgages, 42% of the most recent reading, which was February of 2026, by the way. So quite a few months ago. And then your fixed, 3-year fixed is the more popular. Your 5-year fixed, which is historically, like if you go back to a normal market, well, pre-COVID was historically your most popular rate, is actually the second least common rate right now. So, people are taking the variable. If we continue to see the fixed get more expensive and the Bank of Canada doesn't really chase the bond market, which I don't see them doing, you'll probably see more people start shifting into this variable rate preference environment, which I think we've seen a lot of so far in the last little bit. Yeah, so I'm curious to see how that plays out because I think that creates a little bit of if you go back on this chart, it creates a little bit of an embedded vulnerability to any eventual upside that you might see in rates. Like the last time that we saw consumers pile into the variable was literally the worst possible time in human history
Yeah.
that they could have done that, which was like January of 2022 was peak variable rate taking. And then the warning shot was fired 2 months later. And so everybody who took a variable during that period of time, and it's interesting to acknowledge that this is actually a negative externality of the stress test, because during that period of time, your variable rate was so much significantly cheaper. Most people were choosing it for pricing rather than for out of rate preference or trying to capture downside or whatever. If they were getting 30, 50, maybe even 100 bips less on their rate, it would amplify their buying power because it was below the stress tested rate. Whereas, the fixed now was at 4% at that point because the bond market was already pricing in that rates were going to need to go up during that, around that period of time. So people were qualifying for a fixed at 4% or 6% and a variable at 5.25, which was the minimum qualifying rate. So there's a structurally different reason why people had the variable rate preference during that period of time, but it still did create a pretty catastrophic outcome. So it's worth acknowledging that, if we see consumers really, really pile into the variable, you could end up with a similar setup where the Bank of Canada gets a little bit trapped in how much upside they are willing to create in the interest rate environment so as to not blow out variable rate borrowers again. I think they feel like they maybe learned their lesson. You can tell just the way that Tiff talks at the pressers now
Mhm.
about the future of rates, that he's reluctant to give too much guidance on that. So yeah, I don't know if you have anything you want to add there, but
Yeah, I mean, and how much control do they really have on inflation when it's coming from a lot of it is just coming from higher energy prices right now. So, like,
yeah,
how much control did they have on that? That is, I think that's
yeah,
the question, right? I think he's mentioned that a few times. I know Kevin Warsh has mentioned that in the US. He actually went as far to say that they want to control kind of the after effects, the ripple effects of it.
yeah,
Um, Even that, I kind of question that they're they have the tools to do that.
Well, I think it's interesting because they can still not add to inflation by making credit too cheap and also adding a ripping bull market to oil price shocks, and that's obviously a far greater concern in the U.S. than Canada. Like, and in the U.S. with this massive capex spend, how much money is getting pumped in from foreign direct investment and all of the capital that's going into the AI trade. Um, that I understand why Warsh might feel like, yeah, super low rate environment might be a little bit too risky for them. But in Canada, I mean, our consumers are tapped out. Like, we're back to 180% debt to household income. I don't really feel like cutting rates is going to stimulate the economy too much in Canada. It'll be used as a tool to try and soften the landing that we're heading for. I don't know if Tiff has a similar fear. I think you can
Mm.
see it in the monetary policy report. They're very clear that they're paying a lot of attention to the risk of imported inflation, and that basically if they see CAD, like they acknowledge that we talked about it in last week's episode that CAD has weakened pretty significantly. I think that that's probably the big reason why they're reluctant to cut. I don't think they're reluctant to cut because they're afraid of a domestic bull run inflation or overheating the economy. I think that they're reluctant to cut to weaken the return on the Canadian dollar. I don't know if I need to explain that, but basically, like if your yield that you can earn in a country, you'd have to buy Canadian dollars to be able to buy the yield on to Canada's economy. And so the
It just
the
creates more demand for the Canadian dollar.
yeah,
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 or
exactly.
less.
So
Yeah, yeah. I think that's the
yeah,
simplest way to
and
say it. Yeah.
yeah, so if we weaken the Canadian dollar relative to USD, there's a risk that every good that we import in USD becomes more expensive. And CAD's not
Mhm.
just weakening relative to USD. Like it's not a USD strength story, it's a CAD weakness story, right?
Yeah, exactly. And even for Canadian investors, right? Like I've talked about that on the podcast quite a bit. Like when you're looking at Fed's fund rate, that is what, like 125 basis points higher, 150.
Yeah.
I don't have it right in front of me, but
It's always about there though. Like that's kind of the
mm,
spread that you would want, or not, maybe not that much, but
maybe not that
the
much. But
50 to 100 range, I think, right?
yeah, and if you forget about exchange rate for a second, if you're an investor, I mean, you can't really control the exchange rate. That's out of your
Yeah.
control. What will happen? You can try to predict as best as you can, but what you can actually control is the yield that you get on your money. And clearly, right now, the U.S. is offering a much more attractive yield. You're getting what on the 10-year, you're getting 4.7 roughly now on the Canadian. It's definitely lower. I don't know. I was checking the 5 year, so I don't know a longer duration what it would be yielding right now. But essentially, if you want to invest your money and get some yield, much more attractive in the U.S. If you're looking for tips, so inflation protected treasuries, those have actually gone up in yields that they're offering, and they'll give you, I think your real rate of return is starting to be around like 2.4. It's gone up pretty significantly. So they're becoming more and more attractive for people who want some more inflation protection versus the regular bonds that just give you that fixed yield.
Yeah, no, 100%. What's next on the list? We got lots to cover.
Okay, so let's we talked a little bit about real estate. So let's stick to that and then we can move on to Google. So do you want to talk a little bit about Bridgemark? I know you know the industry well. I did some research on what exactly happened. I was trying to understand the business model. I wasn't super familiar. Correct me if I'm wrong. So the owners of Royal LePage, essentially the business model of a brokerage firm is they get a certain amount per realtor
Yeah.
in each office, and then they also get a percentage of the gross commission that the realtor earns, right? That's the business model essentially.
Yeah. So basically, I mean, they make the revenue in a couple of different ways. They have the monthly recurring revenue, which is desk fees or so like people pay a licensing fee to Royal LePage to have their portion of their monthly fees to have the Royal LePage logo on their signs and access to their infrastructure, CRM, et cetera, whatever. So that's the MRR side. And then the greater portion, So it is interesting, like the way there's a couple different ways that businesses are structured, and Royal Page would be sort of in the old structure, which is probably one of the big reasons why they're having a hard time capturing any upside that you might see um, in the revenue model of a real estate professional. So Royal Page, Remax, and Remax was recently acquired by Real Broker. Real Broker runs sort of this new revenue model, which I'll get to. So Royal Page and Remax, they sell the logo, right? They sell the name, the brand, the
Mhm.
franchise model, and they sell that to brokerages, and brokerages pay them a certain amount, or their agents pay them a certain amount, but they don't actually capture a percentage of commissions. Royal Page added a business called Royal Page Real Estate Services, where they got back into the brokerage trading space. They had a certain period of a non-compete and with their franchisees, and then they also had a certain period of non-compete with I think it was I can't remember the name. It might have been CBRE or one of the big commercial brokerages where they weren't going to trade in commercial space, which has since expired, and they've added a commercial arm. So they are trying to expand a little bit into becoming an actual brokerage and collecting splits on revenue, but that's not the majority of their agents.
Okay.
They collect revenue by paying
Like a
or
monthly
getting,
fee or
yeah,
whatever, right?
license
Yeah.
fees.
Okay.
Yeah.
And so why would this business model work going forward? Like that's where I'm having
Yeah.
trouble wrap my head around it, because what I read, and tell me whether it's right or wrong, is just that they also provide like research, marketing services. They try to provide some value, but nowadays with AI and all the tools that are available, like
Mhm.
honestly, like your network is more important than your brokerage firm. Like, am I wrong here that this is a bit of an archaic business model?
100%. Yeah. Like,
Okay.
and the easiest way to uh, indicate that the market also believes what you just said is the pricing on the Real Remax deal, which we've talked about on another episode.
Yeah.
But
Mhm.
Remax is even more aggressively only exposed to the vintage version of this model, which is we collect fees to rent out our
That's a
logo
nice
to
way
our
to
agent
say it.
builders.
Vintage. It sounds
Yeah,
better.
yeah, that's the organic gluten-free version. The you know the so Real, who bought Remax or partnered, it was more of a acqui-hire, or like a merger. It was closer to that based on, it was a mostly stock deal, and it was like 65-45 or something. Um, Real Broker and a lot of these newer models, Compass, EXP, they're massive real estate brokerages, basically. So they actually can collect the revenue from the realtors as a percentage of the commissions that the realtors earn at scale. This wasn't possible when Remax and Royal LePage got into the business hundreds of years ago. Like I think A.E. LePage, which is what Royal LePage is derived from, was like the early 1900s or like 1920s or something. So, um, or, yeah, I think it was 1920s because they just had their 100-year anniversary. That model depends on their brand having cachet and value. And Real, if you assume that Remax is literally only like their primary revenue stream is renting their logo out, I think 70% of the revenue comes from it. Real basically priced their logo at like $300 million. So it's not worth anything. But the market kind of clapped back and said, well, it repriced the deal, at least from what I could see, at a point where it's sort of saying, we don't believe that there's upside in the real estate trade, period. And this is the same thing happening now with the way that this is traded. And this was in response to, I think a lot of people liked BRE, like Bridgemark, because of the dividend. Like it was a pretty high yield
Yeah.
stock. And then
Mhm.
basically they cut the dividend and posted negative earnings for the first time in decades, which was bound to happen. And can it recover some market share? Maybe, I don't know. But
They cut the
um,
dividend by 96% too.
right.
So it wasn't a small cut. They went from monthly to quarterly. And yeah, they did massive cut. But like I'm showing here, you can see that the writing was on the wall. Like free cash flow was way down and they had kept the dividend unchanged. So I think they're just, it's probably a prudent move if they want to survive going forward, because you can't reinvest money you don't have.
Mm-hmm. Mm-hmm. Yeah, and then I the bigger question becomes like the actual larger structural or cyclical headwinds to the industry, which is, I called it in like 2021 that we probably saw peak realtor like forever in in the industry because, you know, you had tons of people piling into the trade for something to do during COVID. You know, you saw this millennial moment where millennials were all coming of age and rushed into buying in the housing market. You have this huge boomer cohort of realtors retiring and leaving the business. Sales volumes were high during that period of time. And so I think all real estate businesses, but especially ones that are recruiting heavy, like I actually think your traditional models are less at risk because their revenue is really just $100 a month per realtor or whatever, $10 a month per realtor. So like that, it's not, the price elasticity isn't as massive. Whereas like the models that depend on, your EXPs or reels of the world that are, I don't want to call it a pyramid scheme, but like functionally they're an MLM model where realtors recruit one another and sell the sales proposition of the brokerage. And there's a stock options associated with it. And all of these things, which, we can get into another time. Cause I always be curious to hear your take on it. I know I've talked to Mark Cohodes about this,
Yeah.
Mark Cohodes and
Yeah.
he has I mean, like he basically said, it's like, he's like, I'm surprised that the securities companies are comfortable with this. So you have realtors basically out there convincing one another to join their brokerage to get rewarded for transacting and getting stocks that they have whole fixed gates on to,
so they have bonuses to bring in more people
yeah,
because the company
yeah.
that gets more money based on the amount of heads. Okay.
Yeah.
Yeah.
But so you go and look at like a stock chart, like Real or EXP. I mean, they peaked aggressively during that pandemic period. I'll pull one of them up, and then they blew off thereafter. And there's two factors. I mean, one is that new model is like it's easy for Real to come into the market and say to all the EXP agents, hey, well, you're in this layer of that pyramid. Why not come to the top layer of my pyramid, right? And then the other actual headwind is in major cyclical downturns like this, the number of realtors it shrinks massively. Like you go back to the 1990s or the global financial crisis in the US, number of realtors crash significantly, and it takes a really long time for people to start re-entering the business and growing again. And then you also have that coming of age story, retirement story, and the fact that like you mentioned, technology is probably going to start replacing a large part. I really think that peak realtor is behind us, and the profession will continue to decline. And it seems like the market agrees with me.
Okay. And I guess just before we move on to Google quickly, like what's happening? Is the Canadian real estate market doomed for the next decade because boomers can't sell their houses? Like what's going on there? I know you've been posting a lot about that.
I don't think that this is just a Canadian story. I think that this is a Western world story. And I've been researching this like very, very heavily for like 6 years. And I started writing a book like pre AI about this. I never like I thought this was going to be like my life's work, and I would put it out when the actual moment hit. But the moment is starting to hit. You can see it, right? So if you look at like the U.S. market right now, I'm going to pull up like this is probably the most fascinating chart in macro in my perspective right now, which is I got to find a like really good quality version of this chart.
Well, while you say that, I'll just post a little anecdote. I love when you have like big trend and I see an anecdote near from where I live. So there's a house not too far from where I live. It's been listed for like 5 months, and I've seen the couple owns it, clearly late 60s, early 70s. They listed the house. It's a bungalow, nice inside, but I know the market, the area fairly well, kind of seemed a bit on the pricier side. They dropped the price about a month and a half ago by like 10%. Still not selling. There's an open house every single Sunday. I kid you not. And it's still sitting on the market. It's a pretty desirable neighborhood as a whole. It's not that far from center town, but far enough that it's a quiet neighborhood. Typically young families will love to come here, and it's in a price range that should make it relatively affordable for a working couple to afford in these kind of conditions. And it's just been sitting on the market, and they seem to, I haven't talked to them, but my perception is that they're probably kind of fixated on a price.Maybe their retirement is dependent on selling at a certain amount, and they're not listening to what the market is saying, because they were listed throughout the spring period, and now we're entering the summer months. And clearly I think people move less because especially if you have kids, it starts getting harder to move in time for school and all that stuff and the logistics?
Yeah. So, I mean, you're like families. It's funny because people are always like, oh, I'm going to get a better price for my house in the spring. Prices are higher in the spring, but it's actually a selection bias in the data. Most families that are buying family sized homes prefer to purchase in April, May, June so that they can move during the school year, close in the summer, and then get into a new school district. So, you're absolutely right in the seasonal cyclicality of real estate there. Summer, typically you see, you know, um, life event independent consumers, so very much like stronger condo market, smaller product investors, etc. um so yeah, so the thesis that I have is that we hear a lot about this great wealth transfer, right? And how trillions of dollars of assets are going to move from the baby boomer generation to the next generation. And the name of the book that I've been writing, and Nick and I talk about this a lot on the Canadian Real Estate Investor podcast, is The Great House Transfer. Rather than the Great Wealth Transfer, because if you look at composition of assets by household, um, it's easy to look at it by dollar and say, oh, there's tons of concentration in stock and equities and business interests and all of that stuff. But by dollar, that is entirely skewed by the top 10%. And I'll pull up another chart on asset distribution in a second. And actually, I'll just pull it up now because it's probably more relevant to what I'm saying. The if you do it by household, the vast majority of wealth is concentrated in the primary residence, right? So if you look at if you look at your middle income households on average, and this is middle income. So the lower you get more households and more concentration in the primary residence. 61.9% of their net worth, which is like an average net worth of $300,000 or something, is concentrated in the primary residence. As you get wealthier, you get less. And this is a very an interesting thing for people to observe, where we are in a wealth creation. We use housing as our primary wealth creator in Canada. You want to be richer, own less of your primary residence as a percentage of your total wealth. But so take the number of households, the amount of people or the amount of houses that need to sell to potentially fund retirement or have the equity access to fund retirement is massive, as we have the largest generation in human history ever retiring. And the problem is that the next generation, who's the price setter, the buyer, is your Gen Z and millennial purchaser, maybe some Gen X, but Gen X is probably more on the exit than entry phase. On purely a price to income basis, if you take the aggregate purchaser, they are so far away from being able to pay the prices that the market is currently at that it's a stalemate. It's a pure stalemate. And this is like your bid ask table for the housing market.
Well, they're basically in their, like, the younger you are, the less likely you are to be in that upper income.
Yeah, you haven't had as much time to accumulate.
Yeah, exactly. It's perfectly normal. So that makes a whole lot of sense.
But every other handoff of housing wealth from one generation to the next kind of happened in the same price to income range, which is around 3 to 5x. We're at during this period of time when boomers first purchased their houses, that ratio blew out from let's say 3x. There's two major metros in the US that are under that 3x. Actually, I don't even think there's a single one now at this rate. So there's a clear mismatch between the buyer's ability to purchase the assets and the baby boomers hopeful sale price for said assets. Now, a lot of people will say to me when I make this argument, oh, well, they're just going to die and hand the assets down. Sure, absolutely correct. But then you have to go and examine, if that's the thesis that we're using to substantiate why my claim is wrong, we have to go and say, well, what is the most likely outcome of a house that makes it into an estate? And that most likely outcome, statistically by a massive margin, is that the estate sells the house. So they still rely on, because I don't know about you, but I expect that I will be in my 60s, or by the time my parents pass away and I inherit their wealth. I would hope that I've figured out my housing and wealth issues at that point in my life. So I don't think that hedging our economic future on building an inheritance economy is a sustainable way to project for this great wealth transfer, great house transfer to take place. And the other piece is, if I decide that, me and my brother have a conversation and one of us decides that we're going to take over my parents' primary residence and move
Mhm.
into it, I still vacate. I'm a net. If I'm in my 60s, I'm vacating another house to move into that house, if that makes sense, right? It's not like I
Yeah.
was living with my
Mhm.
parents and they died and I'm in my 60s and then I just stay in their house and there's no net. I still have to net vacate a
Yeah.
property. So I'm creating supply while consuming demand. So I don't think anyway, that I'll leave it there because I've been on a rant, but this is obviously something that I've studied a
Mhm.
lot and am passionate about. So I
No,
think
and
it's a
you
big, huge headwind that nobody's paying attention to.
Yeah, and even when there's only one sole hair for the property, a lot of the time it might be like maintenance costs, for example, might be an issue. The
Tax.
upkeep of the house, taxes, all of the other things that are like aside from the actual house, especially if the parents were, much older. Maybe they were not doing all the maintenance required. Now there's some big work. Maybe they wanted to take over the house, but after seeing all of that, they decide not to. But let's move on to another topic. Let's talk. We always talk about AI a little bit. It's hard not to. I mean, it seems like
Yeah.
there's a big set of news every single week. This week there was Google. That was the big piece of news. A couple days ago, they released earnings. If you've been living under a rock, essentially the stock was down 7%. For a company as large as as Google, it's probably, or Alphabet, I guess is the name, but I'll probably interchange Google and Alphabet. Yeah, that 7% is hundreds of billions of dollars loss in market cap, in market value. So it's not insignificant. And a lot of people were kind of wondering why this happened, because cloud revenue was up 82%, revenues up 24%, backlog up 10% to 514 billion. But it really comes down to capex guidance. So really the money that they're spending to build out the AI infrastructure, and it's becoming even more massive. So if you're I'm sharing here free cash flow from Google, and can you notice the outlier then?
Yeah, yeah. I know. I've seen some pretty charts on that. I mean, if you shrink that, it like looks super dramatic too, right? So
Yeah.
yeah,
It's pretty wild. So I know we have some people that'll just be looking at this from just listening it to as the audio, but essentially Google is been free cash flow positive for as far as this chart goes. So it goes back to May 15th, May 2015, and this quarter that just came out was the first quarter that they were free cash flow negative.
mhm.
They are spending more and more on capex for that AI build out. And a couple of things that stood out during the call is, first of all, when they came out in Q4 of 2025 with their guidance for capex spending, it was, I don't have the exact number here, but I think it was like 175 to 185. And then in Q1, they came out and said, oh, by the way, for 2026, it's actually going to be another 5% more than what we had previously stated. And now they came out and then again, they said, you know what, for 2026, it's going to be even higher. So since the first time they came out with their capex guidance for 2026, in the span of 6 months, they've increased it by 11%. They're also saying that it's going to be higher for 2027. And the other thing that was really interesting on the call, and I am flabbergasted by some people that are on X that follow these companies that are supposed to be like expert or they know these companies well. One thing that kept being missed is that the CEO and the CFO were asked a few times on the call, what's the return on invested capital for this AI spent? And they did not answer. They gave some non-answers. They said, "Oh,
Did you
they're
see
seeing."
the news that their new version of like the Blackwell, I can't remember the name of it, has a 10x improvement on tokens per like kilowatt or whatever.
No.
Something
It's their TPUs, right? Is that it
Yeah, yeah.
for Google? Yeah. Um, but essentially, like just to my point here, is they're spending more and more money, but they essentially don't know whether it's going to provide an appropriate return on investment. Sure, there's some amazing number when it comes to backlogs, but these backlogs will have to be filled with some investments. So there's all these issues that are plaguing Google, and you're really changing from a business that for the last 10 decade or so, it was an asset light business, right? So it was an ad business, probably the best ad business that the world has ever seen. And any
Meta gave them a good run for their money though
yeah,
on that.
yeah. Yeah, no, it's but Meta's in the same boat, right? So you had these businesses that were asset light that when you acquired a new customer that was paying you for advertisement, the cost for you for that customer was very small versus the revenue that you were getting. And now you're looking at a business that's spending more and more money. It's no longer an asset light business. They're issuing equity, they're issuing debt. And it's not just Google, it's pretty much all the hyperscalers there. And they don't know whether that will provide a return, an appropriate return on investment. They can't even answer it. And that's the most worrying part when you look at a company like Google is, you're spending all this money, but you don't know what kind of return on investment. And even though they're saying it's helping the business, they don't provide concrete numbers. They just don't. And, it might be a time to buy the company now because the stock has been down. But at the end of the day, I think a lot of investors that are jumping on the opportunity to buy it are just overlooking the potential risk down the
Yeah.
line that these investments just do not return the appropriate amount of returns on the capital invested.
Yeah, you have to be really confident in the revenue thesis that they're creating by pumping this cash into data center spend, which I am. Like, I think it's a good picks and shovels play on the AI trade, where Google, like, as somebody who works, very accidentally, but pretty heavily in the AI space, building tools for real estate professionals, from AI. Like, we basically built an agentic harness that does realtors jobs for them, like 80% of their jobs for them. Um, we've plugged in and trade and benchmark all of these models, and I can show you some other benchmarks that are relative to like all industries. But
Mm.
um, Gemini, it is interesting to me that both Gemini and Meta Muse Spark they don't perform well. And like, you would think, I haven't benchmarked 3.6 Flash, which came out recently, but I just don't have access to it significantly enough in the harness. But um, they're not. You would think that Google, who has all of the data, like they have like the majority of the data from the internet over the last X amount of years, and they know what's important to people and how people use the internet. You would really think that they would have. I mean, data is one of the bigger inputs in creating good AI. You would think that they would have better outputs. And it surprises me that they still, as we're seeing, like Grok, who acquired SpaceX AI acquisition of Cursor, which obviously paid off almost instantly. They released a really high quality model. Um, I don't understand how Google is so far behind on
Mm.
the development of actual models yet. However, they do stand to create a. I mean, the people who are very far ahead on the models, if you want to talk about free cash flow, negative free cash flow, these are like, I mean, OpenAI and Anthropic are cash incineration machines.
Yeah.
And where does most of that revenue go? Well, it goes to Google and Amazon and Nvidia and all of these other businesses that actually own the energy input for these models. So I like that they're kind of hedging the fact that and again, I don't know a ton about stocks, admittedly, to be honest with you. I'm really more of a macro guy, and I learned a lot about this space,
Mm.
the AI space, just from being immersed in it. But um, I just as somebody who like thinks about these businesses, I like that they are hedging against their inability to create good models by getting revenue from another space and still getting good exposure to the AI side of things. I mean, I don't see a world in which, I mean, yeah, chips are going to become more efficient, and then prices you'll probably see price come down, and then that'll probably increase the consumption of AI, because one of the big limiting factors in people really, really actively adopting AI massively at a business level is cost. So I would say that I think that this is not a bad play for them. Do I think that it's
Uh,
priced appropriately on the stock
yeah.
side?
Well,
No, but yeah,
I think that's the issue, right? When you're
mm,
spending now, they're forecasting to spend over 200 billion next year and to
yeah,
pretty much 200 this year. when you're spending that much money and the pricing power comes into question, because we talked about it and you can see it with the various Chinese models, like
Yeah.
you have a wide spectrum of pricing, a very wide spectrum of pricing. And if the cheap, like if you're a business owner, you're going to look for the cheapest model that can accurately do what you want.
Well, yeah,
You
and
know, you're
yeah, yeah. Sorry, go ahead. I'll pull up a really interesting chart on that
Yeah. You might not go to the cheapest model, because if you go to the cheapest model, you might not achieve the results that you want. You
Yeah,
might go like middle of the line. You might use the most expensive. So Claude, Fable, whichever version I forget, but the most expensive model for a few specific tasks that it does very well, but the cost is prohibitive. So you're staying to that model for these specific tasks. And then everything else, you're using a cheaper model. And I think more and more we're just seeing that it's being commoditized. And that's why, like, I think it's extremely worrying for investors when they listen to the call. They have the CEO of Alphabet not able to answer or provide a clear answer on return on investments. And then you see these new models that are coming out every single week, it seems, that have a cheaper cost per token. And especially now, as the top models are really switching to a usage based model. And I've heard a few stories of business owners, people that I know, that were surprised with the bill that they got from some specific models,
for sure.
that are now um, not questioning their AI usage, but they're looking at alternatives that are more cost effective, because as much productivity gain that you can get, that gain has to match the cost that you're paying. If you're getting a 5% productivity gain, but your cost is tripling, something's got to give there.
Yeah. So this is a really interesting saga from my perspective. So I put up the chart that shows how Chinese models are now greater than 50% of all U.S. token share, which is interesting. And there's a couple of things happening. Like you mentioned, the commodification of the models. The other thing that we're seeing happen with the last batch of models is the labs are getting away from trying to create models that are super intelligent, because I think people have realized that super intelligence breakthroughs are not profitable. And only Anthropic really seems to care that much. Like I think that if OpenAI wanted to create a Fable comparable model or Mythos comparable model, they probably would. That everybody saw what happened with the US government getting involved in that. And I've used Fable. It's an exceptional model. It is far too powerful for, like, I don't need that. I'm not sequencing my dog's DNA, which is an example that I use all the time, but some guy actually did that to fix the problem that his dog had. I'm not trying to solve year-old physics problems or anything like that. Like and most profitable things
What
that
about
businesses need.
the meaning of life? Then does it
Yeah.
do that well?
No, no. I'm trying to get it to. I just talk to it as much as I possibly can, so that when I die, my kids can have my AI to talk to that's been trained on my existence,
There
like
you
a
go.
Black Mirror episode. Yeah. Um, no, I think that the Grok, ChatGPT 5.6, that what models are clearly trying to do now is be more reliable at things that people actually need at a better price.
Mhm.
And I just think this is an interesting development, and it's a good thing that AI companies are now saying, okay, yeah, we know that our baseline consumer is somebody who moves paperwork from place to place and needs us to review documents and blah blah blah. Like, we don't really care that much about scientific breakthroughs and whatever. And so we're pushing towards an actual business case for AI. So that's another piece. And then the final piece is the U.S. government, starting to get involved in the conversation with
Yeah.
Kim and accusing Kimmy of distilling Anthropic's Fable. But it's like, this is a funny discussion, right? Because it's like, well, Anthropic distilled the entire internet into a model, and then a Chinese company distilled their model into. So it's like, well, it's bad when the Chinese company does it. So that piece is interesting, and the final piece that I'll mention on that is that Kimmy did something really interesting with the K3 model, which which tells me, like, they've I think they if I'm an AI company and I'm like, how do I do the exact opposite of the competitor that is getting complained about the most, I'd be looking at Anthropic. Anthropic is obviously very famous for putting rate limits on consumers and all of these things. And I think this is going to be a big headwind for their for their IPO, because they quite simply do not have compute, and they can't afford to run their models and provide the subsidy that they're currently providing. OpenAI
Mhm.
can, and Dario said, how Sam Altman was going full YOLO on compute, but it was the right call, right? It was clearly the right call. Kimi, rather than selling more seats on their K3 model and nerfing the models, like if you go try and buy or subscribe to get access to the K3 model right now, you can't get it. So what they did was they actually gated new subscriptions rather than dumbing down the experience and pissing off their customers, which I think was actually a very, very intelligent business move. And I think that that's something that we'll continue to see going forward as you start to get this scarcity effect happen. It is by and large one of the best models that I've ever seen. I only ever use Claude to um, do front end development for the stuff that we do at the company. And I'm not a developer, so I don't really know anything about this stuff. But like as
Mhm.
somebody who is non-technical and just punches in like, please do this thing, it makes them a more beautiful front end. And whereas Claude used to do that better than anybody else, it really is an exceptionally good front end developer for my purposes. And I still use GPT 5.6 for the back. But if that was Anthropic's primary value proposition, I mean, Kimi crushed them on a couple of fronts, which is I think that I mean, SpaceX like felt like they were in a bit of a hurry to IPO. And then
It's funny you're mentioning that. I was actually pulling the SpaceX chart.
yeah,
They
yeah.
may
So I mean, it did feel like they were in a bit of a hurry to IPO, and then I mean, I think whoever IPOs last is in trouble, and I'm so interested to see who ends up being the one. But I think that what we're seeing happening right now are huge headwinds for OpenAI and Anthropic to IPO
Mhm.
in the US market.
I think whoever IPOs next is in trouble. If
Yeah,
this is any indication, and
yeah,
keep in mind, SpaceX has a tiny float right now, and I think a couple days after their earnings that's coming up, they're going to be unlocking, I think 20% of the shares, something like that. And that's coming up, I think, on August 4th, if I remember correctly. And SpaceX, it's down, what, roughly like 15% since the IPO price. And from the peak, it's down about 50%.
yeah,
So it's definitely it does feel a little bit like they may have marked the top here, and it does put into question like how much money investors are willing to be pouring into these AI plays. I think that's a really that's just a really interesting question. And to me, again, like even with what you said and what we've been talking about, I still have doubts as to like if this all this spent on infrastructure, if it'll actually provide the ROI. I just really don't know, because the amount of money being spent right now is just so massive. And just to tie that to the macro side too, if we see a pullback in the stock market, are you going to start to see that top of the K start pulling back on the spending?
yeah,
Are you going to start seeing GDP contract as well if you have the hyperscalers are just saying, okay,
yeah.
well, we've spent hundreds of billions of dollars. Maybe it happens next year or the year after, and you know what, we're not seeing the returns on it, so we're scaling that back. And obviously, especially in the US, GDP is being supported in big part by the AI build out. So what would it look like without that?
Yeah, 100%. No, I agree. I wish I could chat longer. I just realized I have another call coming up, but
Okay.
I think you're right. I apologize. Yeah,
No, no, it's all good.
but the I think that if SpaceX pricing is setting the precedent for what an IPO looks like, I mean, it's going to shake the confidence of anybody who would have piled into that trade on it, like on
Yeah.
Anthropic, OpenAI. And so I think that they're, I mean, you see this, you historic .com bubble, every
Mm.
major, new innovation. It's not to say these businesses aren't exceptional and last and provide something of value and will be profitable in the fullness of time, but I think that their IPOs now are going to be
Yeah.
exceptionally turbulent, and it's going to be a sight to behold, man. It's going to be a fun one to watch.
Yeah, and history has shown us one thing is every new innovation is actually starts off with a lot of capital destruction.
Yeah, for
Yeah.
sure.
No matter how much it revolutionizes
That's
things
creative
going
destruction,
forward.
man. What's that?
Exactly.
Yeah. Is that
So
Friedman?
we'll know in 10, 15 years from now, but I don't want to keep you too much longer if you have to head out to a call. I think it's a good point to wrap it up.
Cool. Yeah, no, I appreciate it, man. I think we got through everything pretty, we rushed through a couple, but that was good.
Yeah.
And, yeah, anything else we'll pick up on the next week.
Yeah, exactly. Yeah, I think
Cool.
we can talk maybe about the Middle East, oil a bit more next week. We'll have one
Yeah.
more week of data, so we can talk about that next week.
Yeah, for sure. Yeah. And I mean, it's a progressing story and we're monitoring the situation. So let's see what happens there. Cool.
Yeah,
Amazing.
that's
Thanks,
it.
brother. Have a wonderful
Okay.
weekend.